As of Tuesday, February 3, 2026, the market has officially closed for the day, and Rezolve AI plc, trading under the ticker symbol RZLV, finished the session at a closing price of $2.68. This represented a marginal decline of 0.04% from the previous session, with the stock oscillating between an intraday low of 2.67 and a high of 2.78. While most traders are busy tracking the standard technical indicators or the latest AI hype cycle, the most critical data point for RZLV right now is the massive supply overhang created by its recent $250 million financing round and the subsequent filing of a resale shelf covering 37 million shares. This creates a unique situation where positive fundamental news is being met with immediate selling pressure as institutional participants manage their newfound liquidity. It is a classic battle between an aggressive growth narrative and the cold reality of share dilution. The common market belief surrounding Rezolve AI is that it is a high-reward moonshot positioned at the heart of the emerging agentic commerce sector. Many retail investors see the company as a sleeping giant that will eventually be re-rated once its partnerships with giants like Microsoft and Google translate into hard revenue. There is a sense of optimism rooted in the company's recent guidance, which suggested a $350 million revenue target for 2026 and a $500 million exit run rate for annual recurring revenue. Investors often point to these staggering growth projections as a reason to ignore the current lack of profitability. However, a deeper look at recent market behavior suggests that the street is demanding more than just projections. Despite a series of seemingly positive catalysts in January, including the close of oversubscribed financing and strategic alignment with new AI industry protocols, the stock has struggled to maintain upward momentum. The price action reflects a rebuilding phase where the stock is trading slightly below its 200-day moving average of 3.34. This indicates that while the long-term story remains intact for believers, the immediate trend is dictated by the need for the company to substantiate its massive ARR claims with verified enterprise deployments and cash flow improvement. Institutional behavior in RZLV has been particularly active lately. Major firms like Alyeska Investment Group and Citadel Advisors maintain significant positions, but the ownership structure has seen notable shifts following the January offering. Total shares outstanding grew by over 90% in the past year, a figure that would cause any seasoned analyst to pause. This dilution is the primary headwind preventing a sustained breakout. When institutional investors see such a rapid expansion of the share count, they often wait for the dust to settle and for the company to prove it can grow into its new capital structure before committing to a fresh bull run. Short-selling awareness is an absolute necessity for anyone watching RZLV right now. The short interest has been climbing steadily, reaching approximately 34.7 million shares as of the most recent settlement period in mid-January. This represents a significant portion of the float, roughly 16%, which has naturally led to discussions of a potential short squeeze on various investor forums. The short thesis is largely rooted in the company's historical losses and the high burn rate required to build out its AI infrastructure. Short sellers are betting that the company will continue to need external financing, leading to further dilution. Conversely, the bull case suggests that the shorts are underestimating the scalability of the agentic checkout model. If Rezolve can successfully integrate its one-tap checkout into major third-party platforms, the volume of transactions could scale exponentially without a linear increase in costs. For retail investors looking to interpret this data, it is vital to watch the borrow rates and fails to deliver. A spike in borrow rates often indicates that shares are becoming harder to find for shorting, which can sometimes precede a rapid move if a positive catalyst hits. However, chasing a short squeeze in a stock with a large shelf registration is notoriously risky, as any sudden price spike can be met by the issuance of more shares by the company or selling by insiders. Comment how many shares you currently hold and let us know your thoughts on whether the current short interest is a sign of fundamental weakness or a coiled spring for the next leg up. The retail sentiment on platforms like Reddit and X is remarkably divided. Some users have posted about holding tens of thousands of shares, viewing the current price levels as a gift before the 2026 revenue targets are realized. Others are more skeptical, labeling the stock as a victim of the SPAC era that has yet to prove its business model is sustainable. There is a frequent call for more transparency regarding the specific commercial contracts that make up the guided $350 million revenue figure. Retail investors can certainly influence short-term volatility through coordinated buying, but they cannot override the long-term gravitational pull of institutional selling if the fundamentals do not eventually align with the hype. Rezolve AI operates in the mobile commerce space, utilizing proprietary large language models to facilitate conversational commerce. Their brain suite is designed to help retailers reduce cart abandonment by allowing customers to find and purchase products through natural language interactions. While the technology is impressive, the company's financials remain a significant hurdle. Losses have historically accelerated at a rate of nearly 39% annually, and the company currently holds negative equity. This means that assets are currently less than liabilities, a situation that places immense pressure on the success of the 2026 growth plan. Looking toward the future, there are several possible scenarios. In the bullish case, the company hits its 2026 revenue targets, the agentic commerce market expands as predicted by analysts into a multi-trillion-dollar opportunity, and Rezolve becomes the preferred transaction layer for AI-initiated purchases. This would likely lead to a significant re-rating toward the fair value estimates of $10.85 per share, often cited in DCF models. The risk is that the company misses its milestones or experiences further delays in enterprise deployments, forcing another round of dilutive financing. The primary upcoming catalysts to watch include the report for the first half of 2025, which should provide a clearer picture of how the newly raised capital is being deployed, and any announcements regarding binding commercial contracts with Tier 1 retailers. Investors should also stay tuned for updates from major industry events like NRF 2026, where the company has a significant presence. To summarize the core insights, Rezolve AI is a company trapped between an extremely ambitious future and a challenged financial present. The stock price of $2.68 reflects a market that has priced in the risks of dilution and persistent losses, but has yet to fully credit the management's aggressive growth targets. The expectation was that AI leadership would lead to a smooth upward trajectory, but the reality has been a volatile journey marked by massive share issuance and a growing short position. The next few months will be critical in determining whether the company can finally flip the script and turn its projections into profits. End with authority and clarity. Watch the $3.10 to $3.40 range closely, as a break above these levels with significant volume could signal that the institutional selling has finally been absorbed.